morning, everybody. It's morning for me. I don't know what time it is for you, but the date is April 16th, and today I would like to talk with you a little bit about the Federal Reserve Bank of the United States. The Federal Reserve Bank of the United States, I would like to give you a little bit of an overview with today. Now, this is not the first national bank that the United States has. The first one was from 1791 to 1811. It was called the First Bank of the United States. It had a 20-year charter. After 20 years, it disappeared. From 1816 to 1836, it was the second bank of the United States. It also had a 20-year charter, and after 20 years, it disappeared. So after 1836, the United States did not have a central bank for a good long amount of time. Do me a favor, guys. I would like you to stop the video right now. Stop my video right now and watch the short video about the first two national banks that I included in this video. It gives you an overview of the first two banks. So I'll see you back in a couple minutes. Guys, so thank you for watching that. So after 1836, the United States for the longest time did not have a national bank. But in 1907, there was a panic, the Panic of 1907. So what happened was a couple of financial institutions collapsed, and people started to worry about, the people that had money in banks started to worry about, well, if my bank collapses, then I will not ever get my money back. So what they did was they did a run on the bank. A lot of people at the same time went into the banks and said, hey, give me my money back. Well, banks don't have everybody's money there. The way they make money is they take deposits and then they loan that money out to people who need loans, and they charge interest on it. So if everybody at the same time wanted their money out of the bank, it's not possible because that money is not all there.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run.
Now, just remember that this thing isn't as black as it appeared. I have some news for you, folks. I was just talking to old man Potter, and he's guaranteed cash payments to the bank. The bank's going to reopen next week.
But, George, I got my money here. Did he guarantee this place?
Well, no, Charlie, I didn't even ask him. We don't need Potter over here.
And I'll take mine now.
No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
I got $242 in here, and $242 isn't going to break anybody.
So as a response to that, in 1913, so these panics would not keep happening over and over and over again, on December 23rd, 1913, then President Woodrow Wilson signed the Federal Reserve Act, creating the Federal Reserve Bank of the United States, which was, in effect, the third bank of the United States. It's the national bank. Now, the way this works is this. Here's me. If I want to deposit money into a bank, I go to, I don't know, say Chase. If Chase wants to deposit money into a bank, it can go to the San Francisco Fed. So I put money into Chase, and Chase can deposit money with the San Francisco Fed. The question is, am I allowed to skip the middleman and go directly to the San Francisco Fed and deposit money there? The answer to that is absolutely not. The Federal Reserve System is banks for banks. It's not banks for individual people. Now, the good thing is that if there was a rush on Chase and Chase was short of cash, they weren't very liquid, they could go to the Federal Reserve Bank in San Francisco and get a loan to make sure that if a bunch of people came in at the same time and wanted their money out and they didn't have enough money, they could get some money from the Fed. It's to avoid something like the 1907 panic. With that said, I would like to tell you a little bit about how the Federal Reserve banking system is structured. In Washington, D.C., there's this thing called the Board of Governors for the Federal Reserve Bank. And the Board of Governors are appointed by the President of the United States, and then they are confirmed by the Senate. So they are kind of like a political organization. It's kind of like a governmental thing. The President is involved and the Senate is involved. So it's like it's governmental. Now there are, at any one time, supposed to be 7 members of the Board of Governors. And each member is appointed for a 14-year term. And that's done for a reason. Let's say we have one member, 14 years. 2 years after that, the next person would be appointed for another 14-year term. That's 14. Terrible handwriting, sorry. And 2 years after that, another person would be appointed for 14 years. I could continue this on for a while, but I'm not going to. So the reason why they do that is because the Board of Governors is appointed by the President. And the President, if he's a Democrat, may have some ideas that are different from what a Republican president would want to have. And they want to keep this spread out so that it's not all Democrats or all Republicans. So a president can only appoint somebody every 2 years, so he or she does not have the option of appointing everybody. Another reason why they stagger out this term is because the Board of Governors is a very complicated job. It takes a while to learn the job. So the way they got this set up is that there's a new person on the Board of Governors. Of the 7 people, only one of them is completely new at the job. I hope that makes sense, guys. Anyway, so the Board of Governors is in Washington, D.C. Those 7 people are appointed by the President and confirmed by the Senate, but that's only part of the structure. Spread throughout the country, there are 12 district branches. Now, this is appointed by the President and confirmed, so it's like a governmental organization. The 12 district branches are not. They are treated like regular banks. Banks for banks, of course, regular banks, and just like a regular bank, they are expected to make a profit. Now, I'm going to put up on the screen a map showing where the 12 district branches of the Federal Reserve are. Do me a favor, guys, and write those down with the corresponding numbers. Take a couple minutes to do that. Do it right now. Thanks, guys. All right, ladies and gentlemen, I hope you got those written down, the 12 different branches. One thing I noticed when I first looked at that map was that the 12th branch, which is headquartered in San Francisco, covers a huge part of the United States. The western third of the United States, plus Alaska and Hawaii. And for the life of me, I couldn't figure that out. And then it dawned on me that back when this bill, the Federal Reserve Act, was enacted, most people lived on the eastern part of the United States. And they designed the district boundaries based on population. Not a lot of people lived in the western parts of the country, so therefore the San Francisco branch covered a huge chunk of territory. That's why. Alrighty, ladies and gentlemen, if you look at a dollar bill, I just pulled this out of my pocket. There's a 12 there. That gives us a lot of information. It tells us where the money was distributed. I'm looking at my list of the banks. This came from San Francisco. Now, it wasn't printed in San Francisco. It was printed somewhere else, but distributed through the San Francisco Federal Reserve Bank. I have this bill. It has a 6. If you look on your list, it means that this bill was distributed through the Atlanta, Georgia Federal Reserve Bank. So this bill, over the course of however many years, made its way west. Somebody must have carried it from the East Coast to the West Coast. Those numbers tell where the money was distributed. Anywho, all right, so the 12 district branches have their own president. They're profit-making organizations, and more about that later. Another part of the Federal Reserve that I want you to know about, super important guys, is the Federal Open Market Committee. Federal Open Market Committee. Now, the Federal Open Market Committee is a group of people that gets together and they examine how the economy is doing, and they make decisions about what their actions are going to be. And it is made up, the Federal Open Market Committee is made up of 12 people. 7 of those people are the Board of Governors. So of those 12 people on the Federal Open Market Committee, 7 are the people that we've already talked about. If I go back to the district branches, there's 12 branches in the United States. The most important one, the one that has the largest amount of financial holdings, is the New York branch. The New York branch has the most amount of money. Why? Because it's the financial capital of the United States. Most of the major banks are headquartered in New York. That's where New York Stock Exchange is. That's where the NASDAQ Stock Exchange is. It's our financial center. So, one person is the New York president. He is always on the Federal Open Market Committee. So, that one New York president, that leaves 11 other presidents. Of those 11 presidents, 4 are on the Federal Open Market Committee at any given time of other 11 branches. And they rotate in and out. If I add up all those people, I get 12 people. These 12 people get together, they decide what their policy is going to be, and then every month and a half, they announce their policy decisions, and people pay a lot of attention to that. All right, what are some of the things that the Fed does? They do a lot of stuff, but what does the Fed do? Just want to go over the main 4. Number 1, they are in charge of monetary policy. Monetary policy, guys, is money supply. Do they want to increase or do they want to decrease the money supply? If they think the economy is going too slow, they might want to increase the money supply. If they think the economy is speeding up too fast, they might want to lower the money supply. And we'll be talking about that in a subsequent video very, very shortly. Just like I can put money into a bank at Chase, Chase can put money into the San Francisco Fed. So one thing that the Federal Reserve does is hold reserves of member banks. Basically what that means is they take deposits of member banks. Another thing that they do is they gather information of what's going on in the business climate in each of the 12 different district branches, and every month and a half they publish that. And I'm going to have you guys look at that information very, very soon. They gather information on how economies are doing. And another big task that they do is that they regulate member banks to make sure that the member banks are following the rules. A couple of years ago, Wells Fargo got into a lot of trouble. It was an unofficial policy from the top of Wells Fargo that the tellers should open up accounts for each and every customer that they have. So even if a customer only wants one account, there was pressure put on the Wells Fargo employees to open up 8 of them, because according to the then head of Wells Fargo, we want everybody to have 8 accounts because 8 rhymes with great. Now, if the tellers couldn't convince the people to open up the accounts, they would do it behind their back. And accounts are expensive, so it was a way of getting extra money for the bank, taking money from the customers. Wells Fargo got in trouble and it was investigated by the San Francisco Fed. Thanks, guys. Hope this makes sense. You're awesome. Bye.